Hey, welcome back to Mr. Market. Thank you so much for joining me. We're now into episode 18. This past week, the market was flat. It was actually down a little bit, about 0.06%, but the uptrend is now starting to break down a little bit, and the algo consequently has turned negative as of Friday. So I'm starting to get a little bit more cautious. When I take a look into what's happening, we start to see that the Federal Reserve is now starting to reverse some of that liquidity that it used to go flood the market in order to go stabilize the banking crisis. And now that the banking crisis is starting to kind of settle down a little bit more, the Federal Reserve is now starting to drain liquidity from the market and reverse that action. And as we've seen, whenever the market gets a flood of liquidity, stocks go up. And now that liquidity is starting to get drained, stocks look like they might start to head down. So trying to be a little bit cautious there. So for us, for the past week, we had a pretty good week. We were up $1,421, and that put us up to $27,183 for the year to date. And as a reminder, our goal is to earn about $50,000 a year, or about 20% a year off a $250,000 portfolio. So we are nicely on track there. So today I wanted to talk about something that's becoming more and more of a concern. I wanted to go talk about the debt ceiling issue. There's this word that you're going to be hearing about a lot more frequently over the next month and a half. This is called the XDate. And that is the date that the US government will run out of money to go pay its bills. Now, this date is a big moving target, and you can drive a bus through the expected dates. So the Bipartisan Policy Center tried to take a stab at it, and they gave some initial projections that it could go as early as June and go as late as November. But now that we have more data, especially with tax day being behind us now, Goldman Sachs came out with an updated note saying that some of the tax receipts that we've been getting have been on the softer side, which is going to accelerate that window a little bit closer to the June deadline. So it's going to be a little bit more interesting over the next few months. The bond market is starting to acknowledge this possibility by raising interest rates right in that narrow window where the government is expected to run out of money. And credit default swaps, which is basically the betting mechanism for the US government to default, is now showing the odds of a default rising at levels higher than we experienced back in 2011. And it's projected that if we default, the unemployment rate could spike and more than double from the current levels of about 3.5% all the way to above 8%. Now, many analysts are saying that it's very likely that we'll get an increase to the debt limit before time runs out. But, even if we did get that right before the deadline, the road to getting to that finish line could be very, very painful in the meantime. That's because the stock market can take some really obscure but very dangerous probabilities and account for it by repricing that risk into stock prices. So that's what happened in 2011. We also had another debt ceiling issue. And back then, as we got closer and closer to that deadline, the market continued to just fall. And at the very end, even though we did get that debt ceiling limit increased, the credit rating agencies stripped the US of its AAA rating, and that caused the market to fall even further. In about 12 trading days, the market fell as much as 18%. So even though in the very end, we were able to get that debt ceiling limit increased, the path to that was still very, very painful in the meantime. So just like back then, we have analysts saying that it's very likely that we'll get a new debt ceiling increase before it's too late. But I think it makes a lot of sense to be careful of the past experience. And even though we may get it just in time, the path to getting there could still be very painful in the meantime. So for me personally, I'll be looking forward to that 2-week window before that expected deadline. And I'll be watching for the trends to go break down in the market. And I'll also be looking for the volatility index, the VIX. I'll be looking for that to start spiking upwards, just like it did last time. And once that starts to happen, that's when we know that we're going to be right in the thick of things. And for me, that's when I will probably be paring back my bet sizes, being a little bit more conservative with my strike prices, or I may just completely stay away from the market and just watch it from the sidelines. I'm not really sure what I'm going to go do because so many things can change this time around, but it's something to pay attention to as we get closer and closer to that deadline. Okay, let's go talk about the stock market. We have a lot of earnings coming up this week. This is probably the biggest earnings week out of the whole season. On Monday, we have Google. On Tuesday, we have Microsoft. On Wednesday, we have Facebook. And on Thursday, we have Amazon. And all of those, except Amazon, have had some really strong runs lately. Now, I don't know how I'm going to go play these stocks, if I do at all, for earnings. As you know, earnings can be a very volatile time, and it can also be very, very profitable from an option standpoint, because we have something called the IV crush, and that is when the options that are outstanding on these earnings plays, they tend to collapse in value right after the earnings get announced. And that's what happened with Tesla and Netflix last week, which I did play. For each of those, they had been pretty much just kind of trading sideways going into earnings. So I didn't really know which way it was going to break. So I sold some calls and I sold some puts. That's called a strangle. And I gave myself a really large margin of error. If you take a look at the implied movement for these stocks, what I typically do is if the calls are worth $5 and the puts are worth $5, the implied move is going to be $10. Now for me, if I have a $10 implied move, I am going to be even more careful and set my strike prices $20 away, just in case I'm wrong. And that's what I did for both of these companies, and it worked out really well. The options collapsed in value by over 90%, and I closed them out the following day for a nice profit. And that's what helped drive our profitability for this past week. Now, as for Google, Facebook, and Microsoft, the situation is a little bit more different because these have been trending upwards pretty strongly leading up into earnings. And my approach is to basically trade in the direction of the pre-existing trend. But in this case, the market has run up so much that I'm inclined to go against that rule of thumb. In this case, I'm not really sure what I'm going to do. I'll probably just stay on the sidelines, or I may do another strangle and adjust my strike prices so I could be at least double the distance from the implied move. But like Warren Buffett said, you don't have to swing at every single pitch. So I may just do that and just watch it go by. I'll have to go see how I feel on the earnings day. For now, I'm short some puts on the S&P 500 ETF, SPY. I have some at the $400 strike price and the $395 strike price. I'm a little bit below the 50-day moving average, and I'm right at the 200-day moving average. So I have a little bit of protection in case the markets fall. And I still have some puts that I sold on the bank ETF, KRE. And I'm expecting that to be pretty volatile this week because we're going to have more bank earnings. And the trend on that one is still pretty horrible. So if I get hurt, at least my position sizes are small enough that it won't hurt me too much. So it's important to remember that if you size your bets properly, you'll be able to do really well in this game. I like to say, if you master the bet size, you master the game. So that's all I've got for this week. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. Or you can find me at these new domains that I bought, so you can jump right to my YouTube channel. It's mrmarket.us and mrmarket.us. So thanks for watching, and I will see you next week.